How do I figure out the right mix of stocks and bonds to hold in my investment portfolio for retirement? Now, what's worked for you while you're working and approaching retirement may not work for you now that you are retired. And last week, we talked about getting clear about what our objectives for retirement investing are. Primarily, they are to allow our withdrawals to keep up with inflation over the course of retirement. And then the second objective, of course, is to make sure that we don't have too much volatility such that we deplete the portfolio too rapidly in the event of a bear market as we enter retirement. In today's video, I'm going to step that a little bit further, and we're going to talk about a useful framework that we can use to get clear on this concept of investment risk and how much risk is appropriate for retiree investment portfolios. This framework comes courtesy of Larry Swedroe in his fantastic book, Your Complete Guide to a Successful and Secure Retirement. I highly recommend the book, and I'll put a link in the notes below if you want to check it out. We're going to talk about his framework, and hopefully this sort of gives you another push in the right direction as it relates to thinking about what's the right mix or a level of risk that I need to take in my investment portfolio as I approach retirement. And if we haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I help people with retirement, and I created this channel to share ideas and concepts that I'm using to help people with retirement every single day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. If you like this video, give it a thumbs up and leave me any questions or comments below. I love getting questions because they give me good ideas for videos that I can create in the future, so I really appreciate it. So let's dive into today's video where we talk a little bit more detailed about a framework that we can use to assess how much risk we should be taking in our investment portfolio. Now, before we talk about portfolios themselves, we're going to talk about the building blocks that I think about when I'm thinking about building portfolios for retirees. And really, there's three major asset classes that I consider appropriate for a diversified portfolio for a retiree. And we're going to talk about them now. So the first asset class I think about is stocks or equities, global equities. The second one is bonds or fixed income. And the third one is cash. And of course, there are many more products that you can purchase to build retirement income plans. You can think about annuities here, reverse mortgages, more exotic investment instruments. I'm going to have a video dedicated to some of these different things later in the series. But for this series, we're focusing specifically on the liquid portion of the retirement investing plan. And now we're going to start with giving you a bit of history on the returns of these different asset classes and the trade-offs that we need to think about when we're considering how to layer them into our retirement plan. So I'm going to go ahead and share my screen with you, and we'll talk about them now. So the three asset classes that we talked about, number one is U.S. equities, S&P 500 equities. And as you can see, the return of U.S. equities since 1926 is around 10.24% per year over that time frame. 5-year U.S. Treasury bonds, 4.87% over that same time frame. And then 1-month Treasury bills, really short-term U.S. Treasury bills, 3.25% per year. Now, you might look at that and say equities are the best investing instrument for retirement. And I agree that equities are a very important part of many retiree investing plans. They're there to provide us with growth, that long-term inflation protection, very, very important, fantastic asset class to own. But there's no free lunch in investing. It's a great saying, and I love to use it, but there's really no such thing as a free lunch. What is sort of the trade-off that we have to then make if we're going to own equities in our retirement income portfolios? And this is where we talk about risk. And I'm going to share this chart with you. I'm going to move over here so you can see it a bit more clearly. But what you're seeing here is those three asset classes. Again, here's equities at the top, and I'm circling it here. The highest return over that time frame, certainly, but also the highest amount of risk, the most volatility. All the way over here, we have intermediate U.S. Treasury bills or 5-year U.S. Treasuries. Lower return, but significantly lower risk. And then finally, 1-month Treasury bills over here, the lowest return out of the three asset classes, but significantly less risk than equities. And to put that into perspective, 5-year government bonds are equities are 4 times more risky, more volatile than 5-year government bonds, historically speaking. And equities are 20 times more risky than Treasury bills. So this is sort of now, I'm trying to give you the idea of the trade-offs that we now need to make when we're figuring out how to mix these different asset classes in the portfolio together. And that chart kind of gives you the idea of the return and risk profile of those asset classes, going back to 1926, but I always love line charts. So I'm going to go ahead and share my line chart with those same asset classes just since the turn of the century. So starting in the year 2000, these are those same three asset classes. So U.S. equities, 5-year U.S. Treasuries, and one-month Treasury bills, of super short-term Treasury bills. And as you can see, equities, the highest return over that time frame. But you can see here in the period between 2000 and 2013, U.S. stocks actually underperformed Treasury bills for that entire 13-year period. And you can see here over that time frame that the intermediate government bonds did have more steady growth over that time frame, higher growth than equities over this particular time clip from 2000 to 2017. So getting that mix right between stocks and bonds through the course of our retirement, like 15 years in a retirement plan is a very long time. So we want to make sure that we've constructed these portfolios using those asset classes appropriately for your plan. So this is all context, this is background to help us figure out how to now approach this question of how do we determine what that mix should be for our portfolios. And from Larry's book, he says there's 3 tests, and these are the 3 tests that we're going to talk about today. The first test is our ability to take risk. And our ability to take risks in retirement as far as our investment portfolios, in my opinion, is really governed by a couple of things. Number one, it's going to be our time horizon and how much time can we really afford to live through a painful period of negative returns. If you're within 5 years of retirement, I would make the argument that your time horizon is somewhat condensed. You don't have a lot of time. And if you don't have a lot of other options, call them plan Bs, in retirement in the event that your portfolio depletes too quickly in those early days, that would then indicate to me that you have a shorter time horizon, you have overall a lessened ability to take risk in that retirement portfolio. So the time horizon, number one, how much time we have until the funds are going to be needed, how much time that we're going to need the funds for, and then also the presence of a plan B. That's another very important component of measuring our ability to take risks. So what is an example of a plan B in retirement if your portfolio encounters a rough patch? Plan B might be to potentially delay retirement if you're not yet retired, potentially downsizing a property, selling an asset, taking on part-time income in retirement. So the higher our willingness to do any of those things, or the more presence that we have of a plan B, the higher our ability is to take risk as we enter retirement. The second major component in measuring our risk tolerance in retirement, or how much risk we should take in our retirement portfolio, is our willingness to take risk. And this is what Larry talks about in the book as sort of his stomach acid test. So how much of a drawdown could we experience in retirement before we reach the point where we sort of panic and we say, I can't take this anymore. I had a portfolio that was worth X, now it's worth X minus 15, 20%. And I've reached the point where I've now panicked and it's impacting my quality of life. I can't live through this anymore. I need to now change something and get out. And we know through researching market history or observing market history that those moments where we've reached sort of that drawdown point, they're almost the worst and most dangerous times to be getting out of the market. But we need to be cognizant of what those points are going to be when we're dealing with retirement portfolios. And to kind of help illustrate where those sort of maximum drawdown periods are for different mixes of stocks and bonds, I've put together this short list of different hypothetical portfolios that I'm going to share with you. So these are model portfolios similar to ones that I use in my practice. And what I've modeled here is different mixes of stocks and bonds. So a portfolio of 0% in equities, 100% in fixed income, going back to 1994, had a maximum drawdown 1-year negative return of negative 9.43%. A portfolio of 20% equities, 80% fixed income, a maximum drawdown of negative 9.76%. A portfolio of 40% equities, 60% fixed income, a maximum drawdown of negative 16.66%. A portfolio of 60% equities, 40% fixed income, a maximum drawdown of negative 25.45%. A portfolio of 80% equities, 20% fixed income, a maximum drawdown of negative 33.46%. And then finally, a portfolio of 100% equities, all stocks, had a maximum 1-year drawdown of negative 40.47%. Now, that is sort of the second component of our model, our willingness to take risks. So think about, where is that point for you where we've reached that maximum drawdown and it's just too much pain for you? And going back to that chart, if you said my maximum drawdown point where I reach maximum pain is around a drawdown of 20%. And so let's say, for example, a retiree who has a portfolio of $1 million in invested assets, a drawdown of 20% from the beginning of their retirement would result in their portfolio going from $1 million to $800,000. If that was sort of their maximum willingness point or comfort point where they would start to get that real stomach acid feeling, they'd be losing sleep, have a lot of anxiety, that's somewhere around half or 50% in equities and 50% in fixed income. And that's an important data point that we need to be cognizant of. So we've talked about the ability to take risk, the willingness to take risk, and now finally we'll talk about the need to take risk. And this one's pretty simple, is what is the rate of return that we need to take, that we need to achieve in order to bring our plan to successful fruition. And remember, we talked about Johnny and Janie, and we kind of keep coming back to their example. But in Johnny and Janie's case, their retirement plan, and I've kind of got it here, we've got elements in their retirement income plan that include investments as well as Canada Pension Plan and Old Age Security. And we learned that in building out their plan, the rate of return that we need to achieve in order to bring their plan to success is around 4.69%. And so that gives us a fairly simple benchmark that we can use to say, hey, what asset classes historically have combined to deliver us that return? And knowing historically what those asset classes have returned, plus with some insight into how to measure future returns, that sort of gives us an idea of where to begin as far as creating their investment portfolio for retirement. So understanding that need. Now, need is subjective. In Johnny and Janie's case, the need that they articulated was the ability to create an after-tax income every month of around $6,500, I believe is what their number was, or between $6,000 and $6,500 per month. And they didn't want to have to be forced to sell their property. Now, if they layered on additional needs, if they said, hey, we also want to be able to give a large gift to our children later in retirement or give a large gift to charity, that might increase their need to take risk as far as their plan's concerned. Conversely, if they said, hey, we don't need to spend $6,500 a month throughout our retirement, or we plan to downsize our home, that would then reduce their need to take risk. It would lower that return target, so we would need to take that into consideration. So the three tests, again, to recap, number one is the ability to take risk, the willingness to take risk, and the need to take risk. And I'm going to go ahead and we're going to share our agenda for the remainder of our series. So we've covered off objectives, we've covered off ability, willingness, and need to take risk. Next, we're going to talk about asset allocation. So we're going to dig deeper into these asset classes that we talked about, stocks, bonds, cash. And then we're going to go from there into a simple system that you can use, stress testing the portfolio, active versus passive. We're going to talk about big mistakes, and then we're going to talk about advanced strategies at the end of our series. So thanks for watching this video. I know these videos are a bit longer, but I wanted to create this as sort of a reference point, just to sort of let you know kind of how I approach these decisions. And hopefully this is a framework that you can use as you approach retirement and think about your investments and make good decisions for your own retirement. Again, thanks for watching this video. If you like it, give it a thumbs up. Questions and comments below. Remember to subscribe to the channel and hit the bell icon if you want to get more videos posted or pushed to the top of your feed when they're posted. Thanks, and I hope that you're having a fantastic day. Take care.